A strike averted. The tide turns in the Ukraine war, possibly. And inflation, well, inflation, it just gets worse. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on just how much economic trouble we may be in.
Headline inflation fluctuates substantially, but we've got a significant underlying inflation problem.
And Dan Chung of Alger Management on staying safe by taking some risk.
There are patterns that you can invest in, even in turbulent times.
The war in Ukraine took another unexpected turn this week as Ukrainian forces pushed the Russians out of territory that they had held for months, raising hopes for people like former U.S. Army Europe Commanding General Ben Hodges.
This will end, I believe, early next year. The Ukrainians are going to push the Russians back to the 23 February line before the end of this year, I believe.
While former Defense Secretary Leon Panetta warned of possible Russian retaliation.
The real issue is whether Putin now strikes back. He already has struck back on the infrastructure, whether he resorts to more, including the possibility of battlefield nuclear.
And President Xi of China took the occasion to make his first trip out of the country since the pandemic hit. And whom did he visit? Well, Russian President Putin in Uzbekistan.
He essentially hitched his wagon to Vladimir Putin. It hasn't gone well. That has gone badly for Xi.
Meanwhile, in the United States, we walked right up to a national rail strike that would do real damage to a fragile economy and then avoided it at the 11th hour through round-the-clock negotiations led by the Biden administration.
We're able to reach agreement, and I think an agreement that really is beneficial to both sides.
But the really big story for global Wall Street were those CPI numbers on Tuesday, coming in hotter than expected, cementing in most minds a path of continued aggressive rate hikes by the Fed, and maybe, just maybe, for longer than we had thought.
The Fed has a game plan. Their game plan is to make sure that the interest rate is higher than inflation. That's the way they believe the way to kill inflation.
But President Biden insists he is not worried.
The stock market doesn't necessarily reflect the state of the economy, as you well know. The economy is still strong, unemployment's low, jobs are up, manufacturing's good, so I think we're going to be fine.
Are you worried about the inflation number, though, sir?
No, I'm not.
Well, if President Biden isn't worried about inflation, the markets sure were this week, reacting with a vengeance to that CPI news, with the S&P 500 having its worst week since June, down 4.8%, and the NASDAQ down almost 5.5%, while bond yields shot up. The 10-year Treasury adding 14 basis points, ending up at 3.45%, and an even bigger story with the 2-year, up 31 basis points, pushing up to just under 3.9%. To help us understand what the markets are trying to tell us this week, we welcome now Afsaneh Beschloss, CEO of RockCreek, and Greg Peters, Co-CIO of PGIM. So, Greg, let's start with you. What are the markets trying to tell us?
Markets are trying to tell you, David, that the Fed has a lot of work to do. Inflation continues to be quite persistent. What I think the inflation numbers showed us is that how broad-based it was. So the focus was on the core number, and the core number came in double what was expected, and the markets were leaning the other way. So I think this is just a reaffirmation that inflation is entrenched in the system. The Fed has a lot of work ahead of itself, as do other central banks, and the markets need to adjust, yields need to adjust, and the economy as a consequence of this higher rate environment needs to slow down.
So, Afsaneh, it looked like the market started to adjust certainly this week. At the same time, how much work does the Fed have in front of it? Because we keep hearing about there's a lag in monetary policy. At the same time, it looks like they're behind.
You're absolutely right. And what is happening is now I think the market has accepted that we're going to be closer to 4.5, maybe more in terms of terminal rates. And that was what shook the markets this week. And as Greg said, this is not just in the U.S. I think the ECB is behind the curve. The Bank of England is behind the curve. So this is more than just the U.S. phenomena. But no question that the medicine will be tough over the next 6 months. And our expectation here is that we would probably end up at probably 4.25 by the end of the year.
Well, the medicine's tough, Afsaneh, but is there any danger the doctor might prescribe too much of the medicine, overreact, because it takes a while for it to kick in?
You're so right also, because policies take a while to work through the system. So we know in Economics 101 that policies, especially interest rate increases, can choke off the housing market. For example, they've started, with 6% mortgage rates. You're going to see the housing market hugely impacted, but that takes not next month, but a couple of months to work through. So no question that we could overcorrect. But I think the Fed, now feeling that they have fallen behind, has that danger of overcorrecting. I think the good news there is that they can always bring in interest rates down a little bit in the early part of next year, but most likely they will be very careful before they do that, because we have seen with Volcker and others, if you bring down interest rates down too soon, you will also have problems.
Greg, there seems to be a pretty broad consensus that the Fed was late to get started, both on rolling off the balance sheet as well as increasing interest rates. At this point, how do they maintain or regain their credibility? Because for a long time, we basically believed in the Fed and it would take care of whatever the problem was.
Yeah, and I think that's the central part of the story, in that they have to get inflation down. I think they realized that they were slow to react, that inflation wasn't transitory. It's become much more entrenched. It's global in nature, as we just talked about. So the way that their success is measured is one way and one way only, and that is bringing inflation down. And the unfortunate collateral damage in bringing inflation down is the economy. So while housing is slower to react, I think what the Fed and other central banks are really focused on is bringing inflation down, because credibility is based on that fact alone. If you think about the prosperity that we've had, at least from a market standpoint, since inflation has been under control, since central banks have built that credibility, they need to get that back, and that's what they're desperately fighting for.
Afsaneh, as you know terribly well, the Fed has two mandates. It's full employment as well as stable prices. Right now, it looks like they're focused on the second, that word, unemployment. How does this work for wage earners as a practical matter? Because on the one hand, you want wages to go up. And by the way, real wages, if anything, have been going down, not up because of the inflation. At the same time, if you really have inflation rampant, then what they're making is not worth very much.
So the emphasis was on increasing employment, and that worked in the first part of the correction. And I think that was what actually led to the Fed being so late in moving towards more equitable more equitable economy. And that is what led to this inflation, which is unacceptable, obviously, to everyone, including wage earners, who are now in real terms getting less. But there is what we're seeing now, for example, with the port settlement this week, with a number of unions getting formed, existing unions successfully renegotiating wages, that we might end up in an economy, and I don't want to be over positive about this, but I think there is a really good scenario where the dance stops sometime next year. Wages in real terms might end up in a better place. And by that, I mean higher. That is obviously going to be at the cost of earnings going down, which means that there will be a reallocation between different stakeholders. And a lot of stakeholders have been talking about labor getting a bigger share of the economy, and that can either be leading to an inflation spiral, or something has to give. And if you could get into an economy where wage earners are buying more, that leads to more consumer goods. It leads to a better growth rate when we come out of this. So I wouldn't be so negative when I read the news about student loans being forgiven or wages going up at this point.
So, Greg, for a long time, it looked like we were solving the equation for the value of assets. We were getting asset values up, which we were pretty successful in doing overall. If, in fact, we're going to take the move that Afsaneh is suggesting right now and say, let's focus on wages a bit more than assets, what does that mean for asset holders? Do we have to have a regime where we're shifting away from asset values toward wages?
Yeah, so I think Afsaneh is spot on with this notion. And the Fed basically telegraphed this when they talked about a part of their mandate is inequality, and inequality is wages. I think what we've seen with this widening of the wealth gap and inequality just growing wider each and every year, is that this trickle down aspect where the Fed's at zero, asset prices go higher, and the rest kind of benefit from that. You really haven't seen that. So the fact that actually wages are going up is a real positive. I do think that has an impact, though. Margins will come down. They're at all-time highs. So there is room for that. But I think we're moving into this new regime from less shareholder value into wages and worker value. And I think that is a story that's going to continue to be told here for some time to come.
Well, some time to come. I'm just curious, if you agree with what Greg just said, are we talking about over a year, over 5 years? How long do you think this transition might be?
I think it's really in front of us as we speak. So I think these readjustments, we talked a lot about the negative part of COVID. I think this is the positive, could be the positive outcome. And what I think is you want more balance, right? You want more balance between stakeholders for an economy to prosper. If you have too much of the share of the economy going to one group or another group, it's never balanced and it's never good for growth. So I think this could be sooner than later, which makes me a little bit more positive that, what President Biden said may not be completely untrue. We might get into a better place sooner than people expect.
Well, after a week like this, I'll take some positive wherever I can find it. Thank you so much, Greg Peters and Afsaneh Beschloss. They're going to be staying with us as we get some advice on what we should be doing with our portfolios given all of the turmoil. That's coming up next on Wall Street Week on Bloomberg.
The outlook for oil is bleakest of the four. We now use 9.5 gallons each day. By 1985, the average household is expected to be using 15 gallons of oil. Yet even at the present lower rate of usage, the reserve on hand would be wiped out in 10 more years.
That was Louis Rukeyser, of course, on Wall Street back in 1973 when he was worried about running out of oil altogether in the globe after only 10 years. Little did we know that at the time we were only 7 months away from an OPEC oil embargo, which really played havoc with the markets. As we were watching the hit movie Poseidon Adventure and listening to the most popular song, that was Roberta Flack's Killing Me Softly. Still with us are Greg Peters of PGIM and Afsaneh Beschloss of RockCreek. So, Afsaneh, you've had a good part of your career dealing with oil. We didn't run out of oil the way we thought we would. There are a lot of issues, including geopolitical ones. But given what we just talked about, that possible paradigm shift from asset value over into wages, if you're maintaining a portfolio, if you're investing funds the way you do, Afsaneh, what does that tell you about what you do? Because it doesn't sound very good for investors if asset values are going down.
David, even in this very difficult year for the economy and for renewables were up about 9%. Now, obviously, this year they fell far behind oil and gas, as we all know. But if you look on a 3-year basis, I have some numbers here. Clean energy was up about 8.9% versus oil and gas, which was up 3.3%. If you look over 5 years, again, renewables have been doing better. So the interesting thing also is that you asked about wages, but there's now more people working in clean energy than in fossil fuels as we speak. So the economy is shifting, and those jobs are actually pretty well paid because there is a shortage of people who have the experience. So in terms of investments, there are a number of areas, obviously, in climate, including food and ag. We're seeing that more people are looking for higher quality food. So there is a big potential for investing in that area. And it's not just in the short term because fertilizer prices are high because of the Ukraine war or supply chain problems. It's a longer term issue. So energy, clean energy, and food and ag obviously have the wind on their back, especially also because of the new Inflation Act that is also going to put resources in that area. But even if we had not had the Inflation Act, you would still have a lot of interest in those areas. The only other two things I was going to say on that front is also biotech and life sciences that also got killed over the last few years relative to the rest of the market are very interesting. We look at it very actively, but again, those are areas where you see startups as well as established companies doing more and more. Last but not least, I would love to know what Greg also thinks if we could be going back to a 60-40 or a 70-30, where people were getting bonds out of their portfolios, but is this a good environment to start thinking bonds if our scenarios about the economy are right?
Yeah, so Afsaneh, so it's, I'm thinking the bond market's a modern day Poseidon adventure when I heard that quote. So I do think the good news in the bond market is that we're largely past the pain. So it's been a really difficult environment to say the least. If you think about just the 10-year Treasury, we were at 50 basis points. Now we're at 340 basis points. So there's been a dramatic repricing. High yields are up, from 4.5% to 9.5%. So I think we're getting closer to the end. And just 6-9 months ago, investors were asking about the benefit of bonds in the portfolio, 60-40 construct. I do think that game has changed. It's still a little early because some volatility is on the horizon here, but we're in a much better place today than where we were back in 2021 and 2020. So I feel pretty constructive, even though I do believe that there's volatility ahead. And just think about how we moved from a Fed pricing perspective, right? So this time last year, there was basically zero Fed hikes pricing to the market. And now we're pricing in, close to 4.5%. So that's a dramatic move, a real repricing. And no wonder why not only bonds were hit, but equities have been hit in the process.
So Greg, let's pursue that 40% of it in the high yield, in the investment, fixed income part of it. We have people on here who say high yield, as you just said, that's a good idea. Investment grade, not so much. Is that where you are?
The high yield market is really different this time in this cycle. Afsaneh talked about energy. So about 20% of the U.S. high yield market is the energy space. That's a very different market going into this cycle than what we've seen in previous kind of economic downturns. It's a much higher quality segment than we've seen historically. All the risk has been pushed off into the levered loan market. Investment grade corporate bonds also much longer duration, lower quality. So somewhat perversely and interestingly, the high yield bond market in the U.S. looks pretty attractive relatively. I just think it's a little early to get too excited as we enter, or the possibility of entering into a recession, as I have yet to see credit spreads stay stable and not widen heading into a recession. So that's kind of where we're at. But it's definitely something to keep on the radar and does change the dynamic of 60-40.
Afsaneh, another thing we hear from time to time is high yield might be the new form of equity, that's the place you want to take your risk assets in high yield. As you look at your portfolio, does that make sense to you?
We're actually looking at maybe a derivation of what you just said, which is a lot of startups got very large funding over the last few years. And as you know, it was relatively easy for venture funds to raise money and for new companies to raise money. That has come to an end. And they don't go to the traditional high yield market, obviously, but as they can't get funding for the rest of their growth, they're looking at new sources of within credit markets. And so we're looking at those markets specifically because we think that there might be a lot of really good value. I think on the high yield market, it's always, it's as Greg said, there's the energy component and the non-energy component. Obviously, the energy component has a lot of oil and gas in it, and so we have not been doing a lot in that area.
Afsaneh, I'm curious about when you talk about renewables, when you talk about some of the biotech, a lot of those firms, including the startups you're talking about, it's really based on the earnings in the out years. They're not making so much money now, maybe not at all. They're going to make it in the later years. As interest rates go up, that discount rate really hurts you, doesn't it? So does that still make it a good investment?
I think it's still, we still are going to do really well from innovation in our economy. So out of those companies, while a lot of them will need 10, 12 years to grow, some of them will not need as long as that. So you hope that your investments start bearing fruit. Some will bear fruit a little sooner, some will bear fruit a little later. But as a whole, you still expect higher returns relative to the markets. Let's not forget, the kind of returns that we saw in equity markets over the last 10 years are unlikely in the next 10 years. And no question that private investments in new startups will still do better in our view.
One last quick one, if I could, Greg, to you on fixed income. When you talk about, again, that 40% of the portfolio, do you have a preference for short duration? Where are you on duration?
Well, so as of right now, we're pretty defensive on the duration side. We're pretty flat. But if you believe that the economy is slowing, then I think being long duration is the defense mechanism. And that's really starting to assert itself. Just look at the shape of the yield curve. So the market's basically telling you that that defensive nature, being long duration, has value. And so that's why it's inverted. As the market, the back end of the yield curve is not keeping up with the front end. Right. So the way I'm thinking about it, we're thinking about it at PGIM is you want to actually be long duration heading into a recession.
Sure is inverted, no question about that. Many thanks to Afsaneh Beschloss of RockCreek and Greg Peters of PGIM. Coming up, we're going to take a look at what's in store next week here on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time to take a look at what we can expect next week on Global Wall Street, starting with Juliet Sally in Sydney.
Thanks, David. Japan will be in the spotlight in the week ahead. Tuesday will bring inflation data that is likely to show the core gauge climbing further above the Bank of Japan's 2% target. But will it bring a Bank of Japan policy shift closer? Bloomberg Economics doubts it. It will be a busy week for rates in other parts of the region as well. China's loan prime rates likely to remain steady, consistent with the PBOC's decision to hold its one-year key rate unchanged. The Philippine Central Bank is likely to raise its benchmark rate back above pre-pandemic levels. And Bank Indonesia looks set to keep going with its gradual tightening.
On Monday, all eyes turn to London, where the Queen is lying in state. Already the crowds have been lining up for it. The day will start with a funeral for the Queen at Westminster Abbey, followed by a procession through London that will eventually end at Windsor Castle, where there will be a ceremony for the family. So it will be a week of more ceremony, more pomp, and importantly, mourning for the country.
All eyes on the Fed next week here in the U.S. as policymakers are widely expected to lift benchmark interest rates by 0.75 of a percentage point. Combine that with the 75 basis point hikes at both the June and the July meetings, and we would have a cumulative increase of 2.25 percentage points in the federal funds rate in just a 3-month span. That would be the most aggressive tightening of monetary policy since the Paul Volcker era 40 plus years ago. The aggressiveness appears warranted following the most recent consumer price report that suggested bets on peak inflation may have been a bit premature. Now, the Fed's silent period has kicked in ahead of that meeting, so don't expect to hear any commentary until Jay Powell's press conference on Wednesday. There will be economic data to watch in the meantime, including housing starts, home sales, and U.S. purchasing managers' data for the manufacturing and services sectors. And finally, keep an eye on big bank stocks. Big bank CEOs, including Jamie Dimon of JP Morgan and Brian Moynihan of Bank of America, are scheduled to testify before Congress at a hearing titled Holding Mega Banks Accountable.
Thanks to Juliet Sally, Danny Berger, and Romaine Bostic. Coming up, whether it's a recession or not, tougher times are coming. And with rates rising, the bloom may be off the rose of those innovative growth stocks like tech and cutting-edge healthcare. But Dan Chung of Alger Management thinks otherwise. We'll find out why. That's next on Wall Street Week on Bloomberg. There isn't much certainty out there for investors these days. Inflation may have peaked.
I think there's consensus that we've seen peak inflation, but the question is, okay, now what?
Or it may not.
The NASDAQ down close to 4%, the Russell 2000 down over 3%, Taylor. Inflation not peaking.
We're headed for a soft landing.
My hope is that we will achieve a soft landing, but Americans know that it's essential to bring inflation down.
Or we're not.
There's a 75% chance of recession in the next 2 years.
But the one thing we can all be certain of is that interest rates are going up.
If there's any doubt at all about 75, they're definitely going 75.
And nothing in those CPI numbers this week will make those hikes any less likely, leaving an investor to think hard about what position makes the most sense in a turbulent time. And we turn now to someone who is responsible for investing a lot of money, over $30 billion in a turbulent time. He's Dan Chung, CEO and CIO of Alger Management. Dan, thanks so much for being on Wall Street Week. First of all, let's get your sense of how turbulent the time is. Are we headed to a recession or not?
We do think we're headed towards recession at this point, yes.
And how bad, how long?
Well, recessions are, of course, very feared events. One of the interesting things about the stock market is it's been a great predictor of recessions, and typically stocks peak 8 to 10 months ahead of a recession. Stocks peaked at the end of December, early January this year. So although NIBOR hasn't officially declared a recession, the stock market is saying we're probably in recession now as we speak.
So, Dan, one of the things that we've seen a lot of in the moving of funds, as well as people talking about it, is as we go into these turbulent times, people are saying that's the time you want to go into value. You don't want to be in growth. And in fact, if you look at some of the big funds, they've lost a fair amount. The growth funds have lost a fair amount. What does history tell us about when you go into a recession, where you want to be?
Yeah, so that's a really important point. I mean, history, there are patterns that you can invest in, even in turbulent times, even through recessions. Very important to understand that because essentially it's about having a game plan, during economic volatility and recession. And what the history tells us actually is that as we enter into a recession, growth stocks, in other words, companies with strong business models, low debt, operating margins that are higher than average, they tend to do better than, say, highly leveraged companies with lots of operating leverage, in other words, a fixed cost structure, and of course, companies that weren't growing particularly well before, that only tend to grow with economic growth. And so what we have seen in the past historically is that as we enter into recessions, value companies, value stocks, tend to have a significant earnings compression, declines in earnings, while growth stocks actually tend to hold up fairly well. Now, the other part of history that's important to note is the first stage of a market correction is really valuation compression. And we've seen that across the board. And it is also classically true that growth stocks compress more than value stocks. But I think we would actually see a lot of signs that part of this market cycle is already over. The next part is really about the economic recession and the decline in earnings that it will bring across the market. And that's where actually growth stocks start to shine.
So Dan, I think it's important in what you said there. It's not all the companies that are considered growth companies. You have a subset that you really focus on.
Yeah, I mean, it's really interesting. Alger's philosophy is focused on fundamentally the disruptors and the innovators across industries, as well as a category we call life cycle change, which are sort of companies that may have experienced tough times that we think are about to experience better times because of innovation or management and leadership. We have some interesting history from top growers. In particular, if you look at the top 75 companies across the largest 750, so the top 10% of growers, their valuation actually has compressed so much that relative to the market now, they're actually at multi-decade lows. And that, again, gives us some confirmation that it's really probably time to start thinking about not so much the start of the recession, which, as I said, probably has started already, but what it looks like coming out of recession and into recession. And that's where, again, these kind of growth stock leaders, the valuations have compressed, the fundamentals are likely to hold up better than average and certainly better than value cyclicals. And we think it's, a good time for long-term investors to think about the opportunities there.
So Dan, let's go a little more specific if we could, because we want to try to help investors make some good investment decisions here. What specifically would you be looking at right now in those growth companies you described?
Sure. So I think one thing you look for is what are the strongest trends in business and in society in the world, and then of course the companies that are leading that, right? The disruptors, the ones that are taking market share. Digital transformation of business is sort of where machine learning, big data, cloud computing all come together, right? This is all about making businesses more efficient in their cost structure, efficient in how they manage their employees, getting more productivity, and of course, efficient in reaching and servicing their clients. And so, when you think about the center of that, that's really software. That's what's driving it. And then of course, the powering of that is semiconductors and hardware. But think about we think like companies like Viva, which focuses on the healthcare industry and making everything from clinical trials to product recalls more efficient. Vast amounts of data that help improve clinical trials results to target medicine, but also lots of data to make sure that if there is a recall, they know exactly, why there's a problem and how to recall it and who has it. It's companies that are, also, for example, of course, transforming every business by moving to the cloud and helping them do that. So every business uses a lot of software. Companies like Datadog, they do application performance monitoring on the cloud. That means, if you have 100 applications running across your company, that may be payroll, that may be marketing, that may be customer service, and of course, maybe your manufacturing or core service capabilities. All those applications, you need to monitor them for their performance, the downtime, the accuracy. And Datadog, for example, is a company that provides software that helps you do that, basically manage your digital infrastructure. So data transformation is incredibly important because particularly in a recession or in difficult times, the most important thing businesses want to do is get more efficiency out of more limited resources, right? Maximize their efficiency.
So Dan, when you talk about life cycle changes, it strikes me that one of the places we're seeing a huge change right now is in energy. As we go toward renewables and we also try to get more efficient in our fossil fuels, what sorts of opportunities do you see there, if any?
Oh, that's absolutely correct, David. I mean, we have liked the renewable sectors, solar, wind, EVs, battery technologies that are going to power electric cars, as well as backup power for a long time. But given the Ukrainian-Russian war, the effect on oil, natural gas, and other prices, the traditional energy industry, which had been in a bear market, is now poised for a transformation, what we call life cycle change, a growth renaissance. And the reasons are very clear. America is, fortunately, now a world-leading energy producer across many fields, not just renewables, but the traditional oil and gas. And liquid natural gas, for example, we're a leading producer. Companies in the U.S. are important not only producing natural gas, but for example, the processes and logistics to ship natural gas in the liquid form across the globe. So we're very excited about the opportunities in that area as well as the renewables area.
One more that applies perhaps to all the growth companies. In general, I think growth companies is, if you look at the life cycle of their earnings, more of them are out in the out years. As interest rates go up, that means there's a steeper discount back to present value. Does that warn you away from some growth companies because the interest rates look like they're going to keep going up for a while?
So that's absolutely correct. It's what we've seen already, I think, the valuation correction for the fastest growers, because yes, the opportunity for growth stocks is what they do 3, 5, 10 years from now in terms of revenues, earnings, and cash flow. But as interest rates go up, those cash flows, those future opportunities get discounted, and investors, of course, become very fearful and tend to focus on the near term. But by many measures, in particular, in the large cap sector, the valuation compression has already gotten to the point where large cap growth stocks are actually relatively cheaper than they have been in decades against the market. And so, we think it's an opportunity to start, picking the best of those growth stocks for of course the inevitable market recovery.
So that's Dan Chung with some really useful advice in these turbulent times for investors. Dan Chung is the CEO and CIO of Alger Management. Coming up, we'll wrap up the week once again with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David West, and we welcome back now our very special contributor, Larry Summers of Harvard. So, Larry, I think maybe the biggest news for the market, certainly, this week were the CPI numbers that really disappointed to the upside here, particularly on the core. What did you make of those numbers?
Look, for me, they were unwelcome, but not wholly unexpected. I think the right reading of the data all along has been that headline inflation fluctuates substantially, but we've got a significant underlying inflation problem. And that's what that core inflation rate, where the month was faster than the quarter was faster than the half year was faster than the year, and the year was faster than last year. That's what it showed, and the month was at a close to 7% core rate. We've got a substantial underlying inflation problem. Another way to see that was that median inflation is higher than it's been any time since we started collecting the data. Another way to see that is that we're seeing substantial inflation in the housing components of the index, which we know have very substantial persistence. Yet another way to see that is in the data from the Atlanta Fed, which I think is probably the best wage indicator on those who are switching jobs, which show where the market really is, unlike those who are staying on jobs, which was running at 8% or more. So we've got a substantial underlying inflation problem that doesn't come out without very substantial monetary policy adjustment, and the market is waking up to that fact and is now building in substantially more monetary policy adjustment than it was, with the terminal Fed funds rate up now at 4.5. If you think back, David, it's been an extraordinary journey. It was only 15 months ago that the Fed was saying that the rate was going to be zero in mid-2023, and now it's saying that that rate is going to approach 4.5. And so the idea that that would change financial conditions can hardly be a very surprising one.
So Larry, let's pick up on exactly that point. As far as you see it right now, what would you project the so-called terminal rate to be? We've got the head of economics at Bloomberg saying 5%. Deutsche Bank says 5%. Where do you think we end up?
That wouldn't surprise me. Certainly at 450, there's more realism in market pricing than there was several months ago. I think we're more likely to end up above 4.5 than we are to end up below 4.5. And it certainly wouldn't surprise me if that rate has to get above 5 if we are really going to, in a determined way, contain and control inflation. Whether the Fed is going to stay the course and do what's necessary to contain inflation, we're going to have to see how that plays down the road. Rick Mishkin, a former Fed governor, had a very strong op-ed this week, making a point that I've made a number of times, that even Paul Volcker had a kind of false start on inflation containment, where he brought down rates in response to bad economic statistics in the spring of 1980, which then had to be reversed and forced us to have even higher rates than we otherwise would have had to have in the early 1980s. So I think it's not going to be easy to do what's necessary. History records many, many instances when policy adjustments to inflation were excessively delayed. And there were very substantial costs to that, again and again through the 1960s and 70s, for example. I am aware of no major example in which the central bank reacted with excessive speed to inflation and a large cost was paid. And so I think that lesson, that in terms of minimizing the risk of a stagflationary catastrophe, the Fed has to be prepared to stay the course, is the important one to internalize.
Larry, as you know so well and have said repeatedly on this program, one of the major components of inflation are wages. We walked right up to the brink of a national rail strike this week in the United States. If we avoided at least tentatively with a tentative agreement, obviously that would not have been good for the economy if there had been a strike. At the same time, what does it say about the hydraulic pressure from organized labor and otherwise on wages?
David, I think we have failed on labor rights in this country over the last generation. It has been far too easy to fire union organizers. We have not done enough labor law reform to support the right to organize, which I think is something fundamental to having an effectively functioning labor market and something that is essential to having a fair and just society. But I do think at a moment like this, when inflation is a crucial issue, the federal government needs to be very careful to keep a focus on all that it buys and all that it sets a pattern for, to pay attention to holding costs down rather than rewarding workers. And I think there are a variety of provisions that try to maximize the wages of those who are involved in activity the government is supporting. And so I worry about provisions that seek to enshrine high wages, for example, in those who are producing goods related to the environment. And I think the federal government has to walk a very careful balance here between restoring appropriate labor rights, which has been a real flaw and huge problem for the last 30 years, and doing things that will entrench inflation through wage pressure to the detriment of the overall economy, including the economy of workers who work with their hands.
And finally, Larry, let's turn to geopolitics for a minute. Obviously, Ukraine had a rather good week, I'd say, with the advances it made in the Northeast, with Russian troops retreating or even an absolute rout. On the other hand, President Putin had sort of a rough week as he met with President Xi, and President Xi has some concerns about that war. What do you make of what's going on there?
I was heartened by the Ukrainian success. But I think that from an economic point of view, we're going to have to be very thoughtful about how we support Ukraine as hyperinflation becomes a greater risk in Ukraine. And I think more broadly, there's enormous uncertainty in markets for natural gas, in oil markets, through those markets, in markets for diesel fuel, and for fertilizer. And a great deal, we don't always say this, but a great deal in the U.S. inflation process is going to hinge on whether, as markets tend to be pricing, oil prices stay moderate or even come down, or whether, as geopolitical experts warn, we hit adverse developments and those prices spike up again. I don't have the wisdom to know which will happen, but I do think it's going to be an enormous factor for the inflation process in the months ahead.
Okay, Larry, thank you once again this week. Our very special contributor to Wall Street Week, he's Larry Summers of Harvard. Coming up, from lying flat to quiet quitting. Could backing off of work be the latest bug that we're all catching from China? This is Wall Street Week on Bloomberg. finally, one more thought. Taking our lead from China again. Much has been made, at least by a certain former president of the United States, of the fact that the COVID-19 virus comes from there.
It comes from China. That's why. It comes from China.
But now it looks like it may be its work habits that are contagious. Just over a year ago, we first talked here on Wall Street Week about the Chinese phenomenon of lying flat. Begun 5 years ago by a 25-year-old factory worker named Luo Huazhong, lying flat is spreading through the youth of China. Tired of the long hours, they've decided to take it easy, giving up their jobs, living modest lives off of their savings, and yes, sometimes off of their parents. And as we all recovered from the pandemic, employers were concerned that some Americans might be lying flat by simply not coming back into the workforce. A problem Sarah Ketterer of Causeway Capital described for us.
The cry we hear from companies, and we interview hundreds of companies, is that they don't have the labor they need. There seems to be this chronic labor shortage, which is something we haven't seen. Normally we talk about slack, and that doesn't appear to be the case. And it's not like the labor isn't there somewhere. It doesn't seem to want to work in many of these jobs.
But now the problem has morphed into its own American version, what some people call quiet quitting, where employees show up but make sure that they do just what they are required and no more.
I will say there's a growing sentiment among CEOs that we are not one good recession away from employers having the power again and employees being in the second chair. There's a growing sentiment that this is more of a permanent shift.
It's far from clear how widespread this quiet quitting is, or even whether it's entirely new. After all, let's be honest, there have always been some coworkers who have been happy to coast a bit. But it does raise questions for those of us who've been in the workforce for a while, whether the old norms still apply.
When you and I started out in the workforce, and admittedly me a little bit later than you, but I mean, to get ahead, you did everything that you could. You were the first in, the last to leave. You volunteered to do every single extra job to get ahead.
But whether it's big or it's small, whether it's new or it's old, this quiet quitting business does pose some challenges for those hard-charging managers that some of us have had to deal with over the years.
We're adding a little something to this month's sales contest. First prize is a Cadillac Eldorado. Second prize is a set of steak knives. Third prize is you're fired. You get the picture?
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.